We've become a nation of one-click wonders, and that has led to a historic boom that was once considered the sleepiest of all asset classes, industrial real estate. Let's break it down. So it all stems from a sea change in the way that Americans shop. E-commerce penetration has gone from about 4% in 2010 to about 13% at the end of last year, with the pandemic acting as a supercharger for growth in the sector. The old supply chain worked kind of like this: have as few stops as possible between the manufacturer and the consumer in order to keep costs low. That was the priority. Now though, convenience trumps all. Same-day shipping, 12 hours or less, instant delivery. It's impossible to imagine a future 10 years from now where a customer comes up and says, "I just wish you'd deliver a little more slowly," Amazon founder Jeff Bezos said in 2017. This past October, Amazon said it was on track to double its fulfillment network over the 2-year period since the pandemic began. The company's portfolio of warehouse, distribution, data center, and last mile properties across North America now spans more than 400 million square feet. That's about twice the office space in all of Midtown Manhattan. This new ethos dramatically changed the demand and pricing for warehouse and distribution space closer to key urban centers, also known as last mile space. It's made the price of real estate close to the consumer more worth it. Chuck Leitner, the CEO of CBRE Investment, told the Wall Street Journal. And Chuck would know, CBRE recently paid $4.9 billion for a 28 million square foot logistics portfolio spread out across the US and Europe. Other real estate players in the sandbox have found it to be very lucrative indeed. Prologis, the industrial giant known as Amazon's landlord, has seen its share price jump nearly 70% over the last 12 months. In the third quarter, its occupancy rate across its 800 million square foot portfolio was nearly 97%, and its quarter-over-quarter rent growth was nearly 27%, which is pretty wild. The shift towards an omni-channel retail strategy that's a combination of online and brick and mortar for many major brands means that supply chains are being upended, and e-commerce sales can require 3 times as much warehouse space as traditional brick and mortar sales, according to Prologis, given the greater number of nodes needed that we talked about, but also the tendency of consumers shopping online to send a lot of stuff back, which requires something called reverse logistics. So how is that all playing out on the ground? In a word, it's a frenzy. All space suitable for industrial use is being snapped up at sky-high prices, and much of the available space in urban cores is being redeveloped for last-mile centers. Investment giant Blackstone has been on a tear. It's amassed a portfolio that now rivals Prologis's at 800 million square feet, and in December, it paid $2.8 billion for a 17 million square foot industrial package. Overall in the sector, there was net absorption of 159 million square feet in the third quarter, which is the highest figure seen since 2008. The majority of leasing activity also involves spaces of 100,000 square feet or less, strongly suggesting that the majority of it is last mile space. So given e-commerce's explosive growth, one estimate has it hitting 30% penetration by 2030, and the American consumer's continuous push for speed and convenience, can the real estate party and industrial ever stop or even slow down? Or let's put it more provocatively, is that 30% estimate just too soft? If e-commerce becomes the dominant way that Americans shop in the next 5 years, could the demand and pricing for industrial space just hit a whole new level? If you just think about the way that consumers are shopping and the younger generation is moving at it, that could very well be the case too. But let us know in the comments below, and be sure to give The Real Deal a like and follow on YouTube and Instagram.